opportunities. We are seeing a lot of traction with this particular strategy. And then depending on how much time we have or how much in questions, then I'll also share with you what I just did with my own personal policy, which is using a stacking strategy. And so I can share that with you. I applied. It's actually kind of cool, how the whole process has changed since the last time I got my first policy. So hopefully we have enough time to do that. But for those of you that are new on this call, I'm going to just back up because I think it's important to cover the concept. And even for those of you that are veterans to the product line, let me share with you just the concept so that you'll understand basically how this works and how easy it is. And then we'll go into the strategy. So let me see if I can share my screen. All right. Excellent. You can see that, Colleen? Yep. Okay, beautiful. All right, so when we're talking about, so let me back up here and let me go ahead and make this big. So when we're talking about using asset-based long-term care, I have to back up and just explain just the basics of how this works. So when you're working with your clients and you're having the discussion on whether or not they need to have this taken care of, which by the way, most of them do, if not all of your clients, if they have money or assets, if they have family, then yes, they probably need some kind of a long-term care protection plan. But what we're doing is instead of using a traditional type of long-term care insurance policy, which means like health insurance or car insurance, where you're going to make a premium payment to an insurance company, and in turn, if that event happens, then they would start paying out for a period of time. Otherwise, with those types of policies, there's no other value. When I die, my family doesn't get a death benefit from my health insurance policy or my car insurance policy. It's done. I paid for the coverage and that's all I get from it. So as you can imagine, that's not very attractive to a lot of folks. And it's not been a great incentive for them to move forward with those types of policies because a lot of clients believe that they are never going to need long-term care. That it's never going to happen to them. It's going to happen to someone else, but it's not going to happen to them. So that disconnect makes it very difficult to progress that conversation forward. So with our type of option, which by the way, we've been offering these for over 30 years. 1989 was our first policy being sold. And there's still a lot of people that are unaware of these options. And it's our job to make sure that people know that they do have these types of solutions or options. So here's how it works. So looking at my screen, this represents, let's say, my bucket of money. I may have some moderate type assets, maybe some aggressive, maybe some conservative type assets. If you asked me, Michelle, how are you going to pay for this long-term care event if it happens to you or you and your spouse? I'm probably going to tell you I'm going to tap into my conservative bucket of my portfolio because it's money that I have quick access to, money that I'm not going to take a huge hit if I did need to tap into it. Usually that's where people have, their safety money. So what I'm going to do is as an advisor, I'm going to say, why don't we reposition a piece of that portfolio? Just move money from my right pocket, put it in my left pocket in order to make sure that I'm turning this into a forever, never-ending bucket of income specifically designed to pay those types of bills. So it's long-term care income, because I'm sure that we all can agree, and we've all probably experienced this within our own families, it is very, very expensive. And this particular event has no end date. We don't know how long this is going to last. So this could be a huge erosion to a good solid retirement plan. So in essence, what we're doing here is we're carving out a piece of the pot to protect all of it. It's portfolio insurance. I don't care how much money you have. This is an excellent way to create a leveraged income that cannot be created anywhere else that is income tax free. And I don't know about you, but most of the clients that I work with, they want as much tax advantaged money as they can possibly get their hands on, especially in what we're all expecting to see in the next few years, which is tax increases, right? So we're expecting our taxes are going to increase due to the spending that's happened. So we want to create as much tax-free income as possible so that we're not paying undue taxes unnecessarily. So the concept is, where does this money come from? Is this cash? Is it cash lump sum? Is it CD money? CDs are paying point squat right now. I saw that. It's actually point squat. They listed that in the bank. Is it an income stream? Maybe I don't have the lump sum saved, but I do have a good income. Maybe via a pension or investment income, or like myself, an earned income. And I'll show you what I've done. I'll make sure that I have time to show you what I've recently done. Maybe I've done well in saving in my employer sponsored plan. Maybe I have 401k, IRA, 403b money, which is probably everyone that you come in contact with. Somebody you know has an IRA. So we have solutions based on any type of money that the client has. So let's move forward. All right, so here's how it works. Now, if you are paying attention at all during this presentation, this is the part I really want you to pay attention to, especially those newer folks that's on this call, because this will help you be able to explain these solutions to your clients in a very simple and easy way. So we use life insurance. We use life insurance to pay for long-term care. Now, we all on this call understand the basics of life insurance, cash value life insurance. So I want you to keep it very simple, and I want you to imagine a cash value life insurance policy, whole life insurance. So we have cash value. That's nice. Cash value is guaranteed that it's going to be there in whole life policy. I have access to it via loans, withdrawals. I can quit the contract and I can get my money, that's in the surrender value. So one, I have cash value. Two, the nice part about a life insurance policy is when I die, not if, but when I die, my family is going to receive hopefully a larger amount, income tax-free, as a death benefit. But the government has blessed certain life insurance policies like ours and says you have a third tax blessing here. You can access 100% of that death benefit, all income tax-free, to pay for long-term care, whether that's nursing home, assisted living, home health care, which is where most clients want to be, home health care, adult daycare, so any form of care. So now I have this larger amount, this larger bucket of tax-free money that I can access for long-term care. So don't overcomplicate this. Don't overthink this. Some reps do. It is as simple as a life policy that I can tap into while I'm alive, income tax-free. Now, clients understand the basics of life insurance. And when I'm talking to clients about this, they don't ask me, Michelle, how does this work if I die? They know how life insurance works. Their family's going to get it. But they always ask me, how does this work if I actually have to turn it on for my care? So what you're seeing on the screen right here is a timeline. This is an excellent timeline. It will explain how this works. It's also in our client illustrations, so you can use the same language when you're presenting to a client. So here's my life insurance policy. Remember, I have cash value death benefit. I can use it for care. So to the left is day one. Day one, I now need care. I'm going to go into a facility. I'm calling up the insurance company to start the process. This is going to pay out over a period of months. And there's different options when we do product training, and I have product training videos. It goes through all of those details. So it just depends on what they chose when they bought the contract. But then at some point, this policy is going to run out of money, right? It's a finite bucket. Let's say that my life insurance policy is $250,000. Well, it's more than what I put in, but I could still burn through it. So at that point that death benefit runs out, my money runs out, if I chose at the time that I applied for this policy, I could have added on a lifetime benefit, a continuation of benefits rider. So this rider just kicks in and keeps on paying as long as my bills are showing up, right? So it's an income stream that will never run out, regardless of how long I need help. So let's back up. So remember that life insurance policy, that will be paid out 100% of the time. You're either going to quit, you're going to live on it, or you're going to die. There's not another scenario there. So the second part that kicks in, this part, there's no death benefit here. There's no cash value here. Again, all it does is it kicks in to make sure that those payments continue. So here's the part I want you to get. So I hope everybody's paying attention. This second part here, this light green part, is really just catastrophic major medical type insurance with a high deductible. Let that sink in for a minute. with a high deductible. Why would I say high deductible? I say that because clients understand what deductibles are. So I'm using client language and they get it, right? They understand the higher their deductible, the cheaper their premiums on any type of insurance. My homeowner's coverage, if I increase my deductible, then I pay less in premiums for the catastrophic part. So most clients understand the catastrophic need. They do not want to pay for Alzheimer's, Parkinson's, dementia on their own. Maybe they do have enough money to pay for the short-term care. It's long-term care that freaks them out. So what we want to do is we want to get the catastrophic coverage, but we want to pay a small amount for it. It's the same concept as a health savings account. Right? I have a health savings account at the company. I have major medical coverage because I don't want to pay for cancer out of pocket. I don't care how much money I have. I do not want to pay retail dollar for cancer, heart surgery, an accident. I want to use someone else's money to pay for that. But maybe I can handle a little bit more with a high deductible, but it keeps my premiums, lower on the back end. So hopefully that concept makes sense. Let me pause right there and have anybody, ask a question or give any kind of thoughts if that makes sense to them or it's very helpful to them. Anyone? Excellent. Then we'll move on. Okay, so keep this in. Oh, sorry, someone has a question.
So with the long-term benefit, is that exclusive to like One America? Because when I was at Northwestern Mutual, I was hearing that it was only like a 6-year benefit. So is that something else to kind of set us apart because we do have that long-term benefit?
Yeah, that's an excellent question. Thank you for asking. So there are several carriers out there that do have some kind of a hybrid. And as a matter of fact, we have a lot of Northwestern Mutuals that write our stuff, by the way, because of the uniqueness of our product. So here's what you're going to find with ours. Number one, the ability to have 2 people on one contract. Most of the time, you're going to find companies that can only serve one person on the policy. This is very beneficial when you have married couples, domestic partners, civil union, those types of things. They want to be both on the same policy because we don't know who's going to need it. I'm pretty sure my husband's going to need it first, but I'm pretty sure he thinks the same thing about me. So, but we really don't know who's going to need it. So to have 2 people on one contract is very unique to One America. Number 2, the lifetime benefit. Yes, there is one other company that offers it, but it's in a traditional form. It's very expensive. They already say they're going to have rate increases every year, and there's no cash value or death benefit, and they're newer to the market. So we expect that. So our actuary, and I probably shouldn't say this on recorded Zoom, but our actuary has said a lot of these companies are assuming their way to profitability, meaning they're jumping into a market that they know nothing about because they don't have any kind of claims paying experience. The fact that we've been doing this for 30 years, gives us a lot of data in order to price the products appropriately. So anyway, I found that interesting. But lifetime coverage is something that you're going to find with us. And then the third thing that you're going to find that's very unique is the multiple funding options. Regardless of what type of money your client has, we can pretty much accommodate any type of funding. So those are the unique things that you're going to find with ours. Now, Jawan, I will tell you, we can also do 6-year contracts. We have the ability of limiting that rider, so we can do those things as well. But you're going to find, especially with 2 people on the contract, lifetime coverage makes sense because you don't want one person to use up 6 years and leave the other person with nothing. So most people will choose lifetime coverage as their option. Any other questions? That was an excellent one, by the way. Okay, great. Okay, so keep this in mind. So I'm going to completely flip the script here. And we're going to start talking about business owners and the opportunity that they have here. So remember, base policy and rider, because we have to separate those in the business world for tax purposes. So let me back up here. Let me go forward here, actually. And let me find my business owner section. So sorry, you're probably getting whiplash from me flipping through these. Okay. All right, so business owners. Many of you are going to work with business owners. Many of you know business owners. And business owners, especially in this climate, if they have a good employee, boy, they want to keep them. They want to do everything possible to keep them, but they would also like to find some unique things that they could do to recruit good talent. Now, the other thing that they deal with is the burdensome rules of these plans that they have to put in place, like 401ks, and they have to offer it to the entire corporation. And so there's a lot of things that they have to follow, and it just kind of bogs things down. So they're looking for, how can I reward key employees? Maybe it's officers, directors, the highly talented people of the corporation, and not have to offer it to everyone, but still run it through the business. So you're going to find, and then I'll share a story with you about a particular corporation that I went and met with personally. And the reason is because they were down the street from me. I was able to do so, and what their thoughts were on this particular strategy. All right, so remember the timeline. We have a base policy with life insurance. We have the rider. I'm emphasizing that because in the business world, we have to separate those two premiums out. So when you run an illustration, it'll give you one premium, but it will separate the life premium from the LTC premium, and that's very important, and I'll show you why. All right, so when we talk about the life premium of this policy, we can't just run that through the business because then it's going to be taxed on the back end. That's just how it works. So we have to be a little creative with this. So what we're going to find is we have an employer, we have a key employee. So Colleen, I'm going to use you. You don't have to unmute, but I'm just going to use you as an example. And let's say Dennis. So Dennis is the employer, Colleen is the key employee. He really wants to take care of her. I wish he was on this call right now because there's some subliminal messaging here where I could, kind of convince Dennis that he needs to do some extra things for Colleen because she's awesome. But anyway, so there's an agreement between the two, between Dennis and Colleen about this particular strategy. So what's going to happen is Dennis is going to pay the premiums for the life policy, but he's going to do it in the form of wages to Colleen. So he's basically going to bonus her that amount of money. So if it was $5,000, he would bonus to Colleen the money she will pay taxes on that bonus, but it's the amount that's needed for that life policy. So he's able to tax deduct that through the business as employee wages. And she, of course, gets the benefits income tax free because it's as if she's paying for that policy out of her own pocket. Now, and I'll show you an example here in just a moment so it all kind of sink in. Now, when it comes to the LTC premium, now that one's a little different because there's extra tax advantages for a business owner when it comes to the LTC portion. So the employer can pay those premiums directly and then tax deduct those directly as a medical insurance toward the corporation. Now, of course, it depends on how they file, and we'll kind of run through that. And by the way, I'll make sure you all have these slides so you don't have to write these down or do screenshots. Now, the key employee, because it's medical insurance in the business world, they get to receive those benefits income tax free. So again, to back up, the employer, Dennis, gets to tax deduct all of that. So wages and the medical insurance premium. So he gets to run it all through the business. But Colleen has to pay taxes on just the life premium. But I'm going to show you how little she's going to end up paying on that amount for her coverage. All right, so here's the example. So let's say that Colleen, today you're 54. That does not mean you're 54. It's just the example. So Colleen is 54 and she is married to a man and he is 56. So Dennis says, you know what? I want to take care of Colleen. I don't want to have to offer this to everyone in the corporation. I just want to take care of Colleen in this situation. I am willing to pay $12,000 a year for this for 10 years. So it's a 10 pay, $12,000 a year. So here's what's going to happen. He's going to pay as a bonus to her $64.93. Now, Colleen is going to have to pay taxes on that, depending on if she actually owes taxes on it. Maybe she has some write-offs, who knows what she owes. But let's just do some quick math. Let's assume that Colleen is in a 25% tax bracket. We're just going to put you in a high one. So 25% tax bracket. That means she's going to pay $1,600 for this, again, $1,600 just because she owes the taxes on this $64.93. She is not going to pay taxes on this $55.09. That is the LTC premium that Dennis is just going to pay directly. So again, she's going to pay $1,600 for herself and her spouse to have this lifetime coverage. What does it give them? Gives them a life insurance death benefit of $141,000. Annually, it's an unlimited benefits. Annually, it's going to provide them each $50,000 a year to pay toward their long-term care expenses, which is really $42.38 per person per month. So again, $1,600 for 10 years, provided that's what she owes in taxes, to provide each of them $50,000 a year toward their long-term care expenses. Now, what does Dennis get out of it? Well, he's got a happy employee. She loves him. She thinks he's fantastic for doing this for her and her spouse. But he also gets to run it through the business, and he gets the tax deduction. Now, it really depends on this piece right here, depends on the corporation. So let me pause right there, because we're going to go over the corporations and the differences and how it would work. Let me stop. Let me open it up for questions. What questions do you have? Colleen, does that make sense?
Absolutely.
Good, 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 good. Okay, so we'll go forward with the corporations. Maybe that'll answer some questions. All right. So first of all, when we talk about the tax deductibility of premiums, this grid here, this cap, they call this the age-related cap, this will apply for individuals. So for instance, when I show you what I do, I use my health savings account to pay for my LTC portion of my premiums. So I'm in this bracket. Don't guess my age, please, but I'm in this bracket. So for 2021, I can use up to $850 from my HSA to pay toward my long-term care premiums. My spouse is in this range. He's 51, we'll just say it. And so I can add $1,690 to that. My LTC premium on just that LTC portion is $2,100. So I can use my full amount, that $2,100 from my HSA to pay those premiums. So this is the same grid that you'll use for individuals, but it's also the same grid that you're going to use for corporations when it applies. So I will show you how that works. So for a sole proprietor, they can tax deduct the LTC premium. So again, we're not talking about the life premium portion. We're talking LTC premium up to that age-related cap that I just showed you. So let's back up. So if Colleen happened to be a sole proprietor, she could tax deduct whatever her age is. She could tax deduct up to this amount. So anything over this amount cannot be tax deducted or run through the business. It's done via an adjustment to income on line 29 of the 1040. So it's an above the line deduction. Like I said, the premium in excess of the cap is not deductible. Now, what you may hear is the 7.5% adjusted gross income. That applies to individuals. That does not apply in this particular situation. So they don't have to exceed 7.5% of their adjusted gross income in order to get the tax deduction. Okay. Partners, LLC members, and S corps. So it is deductible by the employer. It is not limited by the age-related cap. So if it's $5,000, there is no limit to that amount, but it's a business expense for medical insurance premiums. So there's a few questions that have to be answered. K1 for partners or LLC members, they're taxed as partners, of course. If it's greater than 2% of S corp shareholders. What does not apply? This is not an above the line adjustment. There's no age related cap there, and the 7.5% doesn't apply. By the way, like I said, I will send this to you. We also have a tax booklet that I will send to Colleen. She can distribute to everyone. So you'll have all of this information. Non-owning employees, it's deductible by the employer, not limited by the age related cap as a business expense. Not reported in income by the employee because it's employer provided health care. C Corp. Now this is the sweetest spot. So C Corps, they can just tax deduct 100% of the premium. It doesn't matter if it's the owner, if it's the individual, doesn't matter. They are treated as non-owning employees. So there are no cap limitations. It's excluded for employee income. 7.5% of AGI does not apply. So C Corps, and we don't see a lot of them. Most of the time I've seen them as dentists, I'm not sure why, but nonetheless, they can just tax deduct 100% of that LTC premium. So they have the sweet spot when it comes to tax deductibility. So let me pause. Any questions on what I just showed you?
Michelle, there's, pardon me, there's no restriction when you are the stockholder of the C Corp?
No, there's no restrictions on a C Corp, none at all whatsoever. That's the nice part, because they're treated as non-owning employees. So it'd be as if they were an employee, not an owner. And by the way, if you start working with any businesses and they have some unique situation, and I'll explain, I'll share a story in just a moment. We have our advanced salesperson, Kelly Hall, who's phenomenal. And she will walk through and kind of help guide. Of course, we don't give tax advice, but she can at least help guide them. And then, of course, ultimately they need to talk to their own accountant, CPA to make sure it's right for them. But at least she can give some color and some context to the situation. So let me share with you the story. Let me stop sharing my screen here. So there was a business that's not too far away. They had inherited this business from their grandfather. When they inherited it, there are 8 partners. So it's a partnership and there's 8 partners. So they share everything equally. 6 of the 8 is interested in doing what I just showed you, and I'll share their numbers. 2 of them are not, and the reason is because they're older partners and they would not be able to qualify. So the 6 of them, there's 3 cousins and there's 3 grandchildren, and they actually are the ones that are running the company. They're all in their 40s and early 50s. So when we took this to them and we shared them with this idea, of course, they're heavy in cash. A lot of businesses are heavy in cash right now. So they have cash. So when we shared it to them, we just kind of proposed, hey, what if we took $10,000 a year for 10 years? Here's what it's going to give you, basically $120,000 a year that you can pull out for long-term care for yourself and your spouse. So 10 grand for 10 years to get 120 for life. That's a no-brainer. So when we showed it to them, they're like, yeah, we want to do this. This makes absolute sense. And so these people are in their 40s. But the thing that really caught them is that they could run it through the business, that they could use profits from the business on the LTC premium. They could just run that through the company and not have to offer it to everyone. So it was just a no-brainer for them. We didn't have to sell them on the need for long-term care. Clients get the need. Most of them do, even the younger folks. So don't let, younger people aren't going to know about it. I bought my first policy at 38. Yes, they're aware of it because they've seen what happens to grandparents and parents. So don't use your BS, your belief system. Don't have that keep you from talking to someone about this because you never know where it's going to go. So these owners that were in their 40s and 50s, they're like, yeah, that makes sense. So 6 policies, that's $60,000 a year in premium and also FYC. So this worked out really well for that rep. And the clients were like, yeah, absolutely, this makes sense. So anybody working with any business owners specifically that they think that they're already thinking of people, just say yes or no. Yes, I'm already thinking of business owners I want to take this to. Jason's nodding. He's got a beach hut on the beach. He's going to go walk to them right now. They're just down the way.
Not yet, but I'm going to go find me some business owners.
I love it. I love it. And I'll tell you this, they don't know about this. So you're going to be bringing something, even if they don't move forward with it, you're going to be seen as a valuable partner because you're bringing some information that they weren't aware of. Nobody else is talking about this as far as business owners are concerned. They talk about deferred comp and they talk about group benefits, but nobody's talking about this, maybe for the owners themselves. But I'll tell you where I feel like the sweet spot is, it's family-owned corporations. They want to take care of each other. So if you have some family-owned companies, that's where I would probably start. If you really want to niche down, you get to those folks, and I think that you're going to get quite a bit of interest.
Even on this call, there are a lot of business owners on this call.
There you go. All right. Any other questions on that? I know I went through that quickly, but Colleen's recording this so you can listen to it again if you want to. All right, so let me share with you the other strategy called stacking. And this is really, I think this is probably the one that's generating the most interest. And I think it's because it allows for more strategy when you're talking to clients. So it really started with some young people. And so I was doing a joint presentation with someone and they were like, so if we had a couple 45-year-olds, what would you present to them? Well, what usually happens is a rep will say, look, nursing home costs are $8,000 a month. Here's your policy. And they go, oh my gosh, I can't afford that. They get sticker shock, right? Because it can be pretty salty if you fully fund these policies. And for someone in their 40s, I'm just generalizing here, maybe they're focused on paying down their mortgage, paying down their, student loans, maybe saving for their own children's college, paying down their own debt. So they have other things that they're focusing on, saving for retirement. Long-term care might seem like a far away problem for them, and they've got other things on their plate that needs taken care of. So I said, well, what would you do in the case of life insurance to these folks? If you showed them after doing a needs analysis, hey, we looked through this and you need $5 million in life insurance. And they go, okay, well, what does that cost? And you show them and they go, oh my gosh, that's too expensive. Do you just fold up your book and go, okay, well, good luck to you and walk away? No, you don't do that. You say, all right, well, let's talk about what we can do now. And then what we'll do is we'll continue to reevaluate as events happen in life. As you pay down debt, as the kids, graduate from college and you're getting more money, as you get job promotions, whatever it may be, you start to retire. So there's things that continue to be reevaluated when it comes to life insurance. I didn't buy my first life insurance policy, and that's the only one that I still have. I didn't do that. I bought one. Some of them I've kept, some of them I've dropped, I've replaced, I've added to, but I've continued to stack life insurance policies on top of it. What I'm going to show you is doing the exact same thing with long-term care. And I'm not sure why this hasn't been a strategy in the past, but it's becoming quite a bit of a strategy now. So let me show you. Let me get my screen sharing. Got 3 screens, so you never know which one's going to pop up. So, all right, so stacking. All right, so we don't have to go through that timeline again. So here is the hypothetical. So male 45, female 45. And what we're going to do is we're going to talk about a pay to 95 policy. So this would be paid to age 95, and it's whoever gets to 95 first. They're both 45, so they're both going to hit at the same time. But what we're going to do is we're going to try to get the smallest amount of premium with the largest amount of benefit, and we're going to stack policies over a period of years. So the first policy we're going to get is the smallest policy. So we can do a $50,000 life insurance policy. It will cost $1,400 a year. That's a little over $100 a month. If you're talking to clients that can't afford $100 a month, they're probably not your clients yet. They're probably working toward that. If they're, gosh, I can spend that just at the pub down the street on a Friday night. So we're talking about one dinner out a month to get this policy in place. Here's what it's going to provide them. $18,000 a year each, income tax free to pay for their care, which is $1,500 a month. So $1,500 a month isn't a lot of benefit, not in today's day and age. But here's what I will tell you. So I went through this with my husband and we kind of talked about it. And I will, run things past him because he's not in the business. So he gives a good consumer mindset, like he gives feedback like a normal client would. And he said, $1,500, I've heard you present, Michelle, that's not going to be enough. And I said, well, listen, let's put it this way. So our number 1 claim is death, right? Because these are life policies, everybody dies. Our number 2 claim is cognitive issues, Alzheimer's, Parkinson's, dementia. Our number 3 claim usually kind of surprises people, but it's cancer. Because people think of cancer as something you heal from or something you die from, and we miss that battle in between. And oftentimes when people are battling cancer, they need the help. And so I told my husband, I said, look, I'm in my 40s. If I ended up with cancer right now and I'm frail and I'm weak, that's a lot of heavy lifting on you. Would you turn your nose up at an additional $1,500 to pay someone to come in the house and help me in the restroom or help me get dressed or help me get out of bed? And he was like, no, I'll take that. I'm like, exactly. So anything is good, right? It relieves a lot of pressure off of that portfolio, because if I didn't have this $1,500 tax-free check that's coming in, then we've got to come up with that money somewhere else. So maybe we're pulling that out of bank accounts, retirement accounts, whatever it may be, cashing in things that we did not want to cash in. That money relieves a lot of pressure. Something's better than nothing. All right, so here's the strategy that we would present to these 45-year-olds. All right, so we're going to put this first installment in place. And here's what we're going to do. In 5 years, Johnny, he's going to graduate from college. So you just got a pay raise. So we're going to add on your second policy. We're going to stack a second policy. So now we have a total of $100,000 in death benefit, $36,000 a year each, income tax free. 5 years after that, Sally, she's going to graduate from college. You just got another pay raise. And then at age 60, you're at the height of your earning and you're looking toward retirement. So we're going to add on a last policy. So aggregated together, you've got $79,31, $200,000 in death benefit, $72,000 a year each, income tax free for the rest of your life. Now, If they waited until they were 60, what would that cost? Now that's 15 years from now. So we can figure that the insurance company is probably going to have a rate increase at some point, right? But let's assume it stayed the same. They would have paid $10,000 a year instead of $7,900. So that's, a $3,000 difference, we'll say. So there's some dollar cost averaging, if you think about it, just by spreading that out over the years, buying it a little bit younger and then paying for that over time. But here's some things that I would get from the client or from reps. So, okay, Michelle, we go forward with the strategy. Well, what if she gets a health condition at age 54 and it disqualifies her from any more policies? Okay, are we glad we got that for her? If we had waited till she was 60, she'd have 0. So I'm glad that we've got something. What if the insurance company says, we're not selling this policy anymore and they're 59, they don't get to do the last one? Again, aren't you glad that we got those 3 policies intact? Absolutely. What if they buy these policies and they make it through age 60? Now they're in their 70s. He dies and he had the pension, but he did not choose a survivorship option. Guess what happened to her income? Her income just dropped. And now she can't afford all of these. So what do? We just dropped the last one. We dropped the most expensive one. We still have something for her to pay for home health care, assisted living, whatever it may be. And now it's affordable for her. If they had one policy, we can't change it. We can't adjust the premiums because it's all rate locked. Everything's guaranteed and it's in place. This allows for that flexibility. So what this does is it allows for you to start helping clients at a younger age, which they're healthier and all that, so it's a lot easier. I oftentimes will use this, a fast nickel's better than a slow dime, right? We don't want to wait 15 years to get these clients to get policies. We want to start working with these people now and doing it over a period of time. It also conditions them for those next policies. They're already prepared because you discussed the strategy to them. Now, I will tell you my first policy, so let's back up. The numbers aren't going to match, but my first policy I put in place was giving my husband and I both $4,000 a month each for life. Now, on the base policy, we did not put inflation protection. So we can tweak and tailor these products to fit whatever we need. But my rider, so when we get into that lifetime rider, it has a 3% compounding inflation. So the reason why I didn't put inflation protection on the base policy, inflation protection is pretty expensive right now because insurance companies would be obligated to pay those when we're in a low interest rate environment. So they charge a lot for it. So it's really a cost saving measure. But then I also figured the first 2 years, which is where I would go through my life insurance policy, that's probably when I'm just beginning needing care, where it's going to be less expensive. I'm not in full-blown nursing home care. Now, I want my rider to be full-blown nursing home, but maybe in the beginning, I'm just adult daycare, home health care, where it's less expensive. And I'm just figuring maybe I can supplement the first couple of years with my pension, my retirement income, whatever it may be. But once I get to, after 2 years, I need that full coverage to kick in and cover me. So what I just did was I just added my second policy. But this one, I did not add the rider. I'm only stacking a base life insurance policy. And it cost me this, so to add on another 100,000. So I'm adding on another $4,000. So it's $4,000 on top of my other $4,000. It's going to cost me $1,800 a year. So $150 a month. And to me, that makes sense because I'm rate locking those premiums. So my whole point in telling you this and what I did, and you can do so many different things. There is not a one size fits all with this. You can tweak and tailor to fit whatever it is that client needs or what they're trying to accomplish, with their other strategy and their other financial plan. That is the really cool part that you get with the One America products that you're not going to get elsewhere. Like I said, I didn't even add the rider to my second policy because that's already got that built-in inflation, but my base policy doesn't. So I'm just going to stack. Basically, I'm buying my own inflation protection, but I'm doing it in the form of using life insurance so it's not wasted. If I bought inflation protection and I don't need it, that money's wasted, but at least my kids are going to get this. So, all right. What questions do you have about stacking?
Are these life insurance policies like Whole Life 95? Can we add those riders to those type of policies?
No. So that's a great question. Thank you. So under One America, the One America umbrella, we have AUL, American United Life, and they have their own set of just normal life insurance policies. They got term, they've got whole life select, they have all those things. Our products are written on state life insurance paper. So it's another company underneath the One America name. We just say One America because that's our branding, that's our marketing. But technically, these products are written on state life insurance paper. We share all the same financials under One America and AUL, but they are written on different life insurance paper. So asset care, annuity care, those are the only products that we write under the state life insurance name. That's a great question.
Michelle, when you are coming up with the long-term care benefits, how are you coming up with that? Is that based on the amount that the client can afford, or do you do like a needs analysis to figure out how to do that over a three laddering process or a 4 laddering process?
Yes. Yes to
Yes.
both. I think it really just depends on the client. You know, so oftentimes what I'll do is I will just start at a point that I think that they would be receptive to. And then I let them, you know, just basically listening, you know, we all know how it is in sales. You listen to what they're saying, and then we can adjust and tweak accordingly. So sometimes I'll even show them, here's option A that I see a lot of people in your situation and here's option B. Oftentimes they'll choose one or the other versus yes or no. So it really just depends on the client. If it's an affordability issue, then I'm looking at premium and I'm just trying to maximize it. If they are, you know, sometimes they have lived it, they're currently living it, and they go, I don't want to mess around with this. I know how expensive it can be. I don't want to put this on my kids. I want to make sure that someone else is going to be doing the heavy lifting. Get me the best that I can get, whatever it costs. So it really just depends on the client.
Thank you.
You're welcome. Great question.
Now, what would you say is the sweet spot age for starting this? Would you say around 45, 40, 50?
I would say under 60 would be the sweet spot, whatever that is. The reason is once you hit 60, oftentimes, again, generally speaking, we start to deal with some health conditions, but then also at age 60, they have to do a memory test. Not that it's difficult. I mean, if you don't have memory issues, you don't have a problem passing the test, but it just adds another layer of, you know, complexity to applying for these policies. If you're under 60, 59 and under, you don't have to do that test, that memory test. It's just a telephone call test. So if we can get them younger, again, they're locking in premiums at a younger age. We're also getting them covered. If anything happens, strokes happen at any age, cancer happens at any age, accidents happen at any age. These policies will pay out kind of like a disability policy. They're just going to pay for the care part. So I would say 35 to 59, if you have clients, we just need to change the way we think about this. Again, I talk about advisor BS a lot, our belief system. Sometimes we tell ourselves this client isn't going to be interested in it because of their age or because of their financial status or their marital status. You will be surprised. You will surprise yourself when you start talking about this with clients that they are going to be interested in this. And you'll also find there's some clients that you think it's a no-brainer and they're like, nope, I don't want it. It's kind of strange how that is. But I would just say, start talking about it with everyone. Even if they don't buy right now, you're the one planting those seeds. So when the time is right, they're going to come back to you because you were the one that brought it up to them. Good question. Yeah. Anyone else? Am I still sharing my screen? I can't tell.
Yeah.
Yes.
I am. Well, I can't find my little, oh, there it is. I kind of covered it. Was that helpful? Business owners and stacking for younger folks?
What's the youngest that somebody can get this?
Age 35. And we have them, believe it or not.
What's the underwriting process like?
So the underwriting process, so I'll just tell you what just happened with me. So actually I can show you because I saved it. So I go through the e-application, and if they're younger and healthier, they've seen their doctor, you know, on a pretty regular basis, there's a question that will pop up and it'll say, do you want One America to fill out the medical portion of the application? You guys all know how life insurance works. You can ask the medical questions, you know, their medical history. Do you have blood issues, heart issues, whatever? Or you can punt and have One America do that. One America does not do that. It's actually a third-party vendor called LTCG on our side that asks those questions. So because I am healthy, I don't take any medications, I don't have any health conditions, I see my doctor on a regular basis, I went ahead and clicked to have that done because it's LTCG that I will schedule a phone call. Now, as soon as I submitted that application, I got a text that says, you can see that right here, you probably can't read it, but it says, "Hello, Michelle, thank you for applying for a policy with One America. We will need to schedule a phone assessment to complete the process. Please go to," and they have the link to schedule your call. So as soon as I click on that, it opens up and it allows me to schedule that call at my convenience. Now, the first available was 3 weeks out because they're completely bogged down because there was another state that made a tax law change that just flooded us with business. So it's really just kind of, usually it would be within a day or two. This was 3 weeks out. No problem. It is what it is. But then it says, I got a second text that says, "Hello, Michelle, thank you for scheduling your assessment for 10:20 to 10:50 a.m. on 9/28. Our call may come within a half an hour window of the scheduled start time. Please make sure you have your prescription and doctor's information present for the assessment. If this appointment date is no longer convenient, you can change it." I also got an email that says the exact same thing. So the really cool part is they are already preparing me. Have your doctor information, have your prescription medication already available for this phone assessment. We also have a document that is kind of like a homework assignment that you can send to your client and say, look, we don't need this back. This is just for you to have all of that information to make this telephone interview go quicker, so you're not going to your medicine cabinet trying to figure out your milligrams. So once that happens, so I'll do the telephone interview. Because I am under 60, I don't have to do the memory screening. They're just basically going to ask me my medical history, and then the phone call will conclude at that point. They're going to send a report to the underwriters. The underwriters will look at that. They can either approve just based on that, or if there's something that I said in there that they go, not enough to decline it, but we do need to have more information, they may ask to flip it to a full underwriting. They may ask for blood work, urine sample, paramed, so they may need physical requirements and or medical records. So they may want, maybe I had cancer 3 years ago. They may want to go get a medical record. Doesn't mean I'm going to be declined. They just want to see what was the staging, how was I treated, how am I doing now, have I stayed up with my doctor's appointments. So they might just need more information in order to make a good decision. At that point, we get all the medical stuff in, they make a final decision, declined, approved, or rated. So we can rate cases. So just adding extra premium for, health conditions. Does that help? Good, good.
If someone gets declined, do we have any options for them, or is that it?
We do. So oftentimes medical records are, they're just like credit reports. If there's something bad in there, we're going to make a decision based on whatever we see. So oftentimes we have, I'll tell you an example that I had. So we got medical records because this lady had some medical event. She went to the ER. Well, the ER doctor put in there showing signs of memory loss. That is not good. One, that is not a test that was put in there. It's not her normal doctor. But when we get that, think of it from an insurance company. We're like, we don't want that business. If she already has memory loss signs, we don't want it. So we have to, again, we look at risk. So, she took that information. She didn't know it was in there. So when we send the decline letter and the reason for the decline, then she took that to her primary care physician. That primary care physician said, nope, I have been seeing this lady for so many years. That is not an assessment at all. She does not have memory issues. That ER doctor should not have had that in there. And we approved her. So sometimes it's not that easy. Sometimes if they get declined because they don't pass the cognitive screening, like the memory recall test, they have to go and get their own neuropsych evaluation, which can be costly, and it's on their own dime. So here's what I will tell you. If you have a client that is 60 and older, that memory test is not difficult to pass. They pass it all the time. But here's the biggest thing that gets failed. They don't pay attention to the memory word recall. So what's going to happen is they're going to be given 10 words. They have to repeat those 10 words. They use each word in a sentence. So if it's a cloud, it's a cloud, I see the clouds outside, they're going to say it in a sentence. Within 15 minutes, the examiner is going to come back and say, now, how many of those words do you remember? They have to get 6. If they get 5, they will fail and they will be declined. So they have to get at least 6 of those words. So you can help coach them and let them know that is an important part. Don't have your grandbabies running around distracting you. Sit down, have your coffee, be in a quiet place, pay attention. It's not difficult, but you do have to pass that part.
Yeah,
Good stuff.
Michelle,
Yeah.
I've also found the pre-underwriting inquiry to be very helpful.
Yes, thank you, Jeff. So the preliminary underwriting inquiry form, and I'll make sure that that's sent to Colleen as well, so she'll send it out to all of you. That's an excellent tool that we have. If you are working with a client and I just had one right before this call, esophageal, I can't say that word, cancer. They had it 3 years ago and they're like, what do you need to know? And I said, here's what you're doing. You're going back out to that client. Cancer is one of those funny things. We need to know staging, how they were treated, how they're doing now, all of that kind of stuff does matter. So when you fill it out on that form, you can email that to an underwriter. They will email back to you within about an hour and they'll say, yes, we will consider them, or no, we won't. So don't even bother applying. They don't say it in those words, but when they say, no, we won't consider, what they're basically saying is, don't waste that client's time. We're not going to consider that health condition. It saves you a lot of time. It saves that client a lot of time, and heartache and having to go through the entire process. It's an excellent tool. It is not an approval. What they're saying is we will consider that. And sometimes they'll even say with full underwriting, meaning don't even bother going through that telephone interview because we're just going to flip them to ask for blood, urine, and doctor's records anyway. So just go that path. By the way, I also have videos, a lot of videos on all of these subjects, on underwriting our products, how the products work. I'll make sure that you have links to those as well.
If we have question, should we go to you? Should we go to Tanya?
So I'm on the road quite a bit, and I'm also in meetings like this. So sometimes it can be difficult to get me. I would say don't try to call me. There are times that I'm available and I can actually take a phone call. But if I'm on a plane, if I'm driving through a tunnel, if I'm on a virtual meeting, I'm not going to be able to answer your call. So you can send an email to me. I can answer those on airplanes. Tanya is my internal sales partner, and her job is to be there when I can't. So she's always available. Even if she's not, she has a pod that is able to answer any questions. So if you just have quick questions, underwriting, you need a quote, you just need a product question, go to Tanya. If you're having difficulties, maybe with a current case that you're struggling with, maybe it's a strategy and you just need you need a good idea as far as how do I work this case? Yeah, send me an email, reach out to me. We can schedule time to talk, but Tanya's going to be your go-to person for quotes, quick questions, illustrations, product materials, whatever you may need. She's going to be the person to go to.
Awesome.
Good
I know
stuff.
you got to get to your next
Yes.
presentation, so we appreciate your time.
Thank
Awesome,
you.
as always.
Yeah. Thank you.
I'll get Michelle's recording and all the materials out to you. I will send her and Tanya's contact information as well. My biggest piece of advice is if you are a business owner, which most of you are, put this strategy in place for yourself. See how it works. Then you're able to talk about it with your clients and business owners that much better.
Excellent. Excellent. Good deal.
All
Well,
right.
thank you, everybody.
Thank you,
Appreciate
Michelle.
your time. Thanks. Take care. Have a great week.
Excellent.
Thank you so much. I appreciate that.
Mhm.
Thanks.
Thank you.